Hi, this is Ty from NAV. I'm really excited to be here today. I hope you are too. We're going to talk about preparing for a small business loan. I'm going to share a little bit of inside baseball so you'll know about the questions that you should be asking and maybe why some of those questions are important. So basically, we're going to talk about 10 questions to ask before you apply for financing. And some of these questions are going to be from the lender's perspective. So be prepared for that. One of the first things you need to do, and this isn't one of the 10, this is just a bonus. The first question you need to ask is, what's my loan purpose? And the reason you ask that question is because it's going to help you answer a lot of these other questions. So, are you borrowing to buy inventory, for example, or are you buying to move your business across town? Those are both very different reasons to borrow. They're both very legitimate reasons to borrow, but they're going to impact how you answer the questions, or at least some of the questions, a little bit differently. Also, lenders basically need to know three things, and they're not going to ask them this way. But in the back of your mind, you should be thinking in these terms. The first question is, can you repay a loan? They want to know that you're able to make the periodic payments. That's why they ask about your income and some of those questions. The next question they want to know the answer to is, will you repay a loan? And this is different from the first one because this is more about your history. Have you, they don't know you now. Basically, they're going to try to make a judgment on what you will do in the future based upon what you've done in the past. And so they're going to look at your credit history. They're going to look at how long you've been in business. They're going to look at those types of things to help them determine if you will repay a loan. And then the last thing is, what will you do if something unexpected happens? Most of us are borrowing for a reason. And hopefully, in my opinion, a primary reason is to improve the profitability of my business. But what happens if something gets in the way of that? Do you have the financial means to continue to make periodic payments regardless of whatever happens? So as we go through these next 10 questions, they're going to kind of be answering some of these. So basically, lenders are going to evaluate your business. They're going to look at your revenue, your credit profile, how long you've been in business. Some lenders, not all of them, want to know how you plan to use the money, but you should know that. Like I said before, that's the first question that you ask. And then what's the likelihood you will pay back the money that they lend? So let's dive in. The first question, how much money do I need? And this is like the first reason why you ask, what am I borrowing for? Because how much money you need is going to impact where you look for a loan, the type of financing that'll work for you. And years ago, I used to be involved in a little bit of business development. I'm not a salesman, but I would sit in on some of those phone calls. And when the salespeople would ask, or the loan officers would ask, how much money do you need? There were a lot of business owners that said, well, how much can I get? Which is not the right answer. I grew up in a small business, and I will admit that my view on this is a little bit conservative. But basically, my father taught me that there are basically two reasons that you borrow. The first reason is to improve the ROI of a particular project, or you borrow to increase the value of your business. He used to say that regardless of where you borrow money, there are costs associated with it, and borrowing money can get expensive. And so if you borrow money that you don't need, or you borrow more money than you really need, it can cause more financial harm than good. A few years ago, I was on a panel with a bunch of other lenders. We were talking to Amazon sellers. And one of the questions was, when should I borrow and how much should I borrow? And one of the lenders said you borrow as much as you can whenever you can because you never know when you're going to have a chance to borrow again. And I don't agree with that. I think you borrow when you need to, and you borrow as much as you need, and you don't borrow any more than that because money's expensive. So you're going to want to figure out what your loan purpose is, exactly how much money that you need, and that's what you're going to ask for. The question number two is, how fast do I need it? This is another question that's answered by whatever your loan purpose is. For example, if you're a retailer or a wholesaler, sometimes you may get a call from one of your suppliers saying, look, if you can buy X number of widgets today that you normally sell over the course of a month, I'll be able to give you a discount, but you need to act fast because I can only offer the discount for the next 10 days. That's a little bit different situation than buying maybe a new forklift or upgrading the interior of your building. Sometimes you need money quickly, and how you get money quickly is can be a challenge because a traditional lender like a bank, for instance, they're going to take a week or several weeks to get you financing. The SBA is going to take even longer than that, sometimes even months, whereas an online lender can give you an answer that day, and oftentimes you can have the money in your bank account in the next business day. So what you need the money for is going to determine how fast you need to get it. And if it's going to take too long to go through the loan process, whatever that opportunity is, you might lose it. So, the next question is, how fast do you need the money? And then the third question is, what does my credit profile look like? And this is how lenders answer that second question. Will they repay a loan? And if you're a small business owner, I know that your personal credit score doesn't reflect how you pay your business bills, but for most small business owners, your personal credit score is always going to be part of the equation. So and your personal credit score is like a go no go metric for a lot of lenders. For example, if you go into a traditional bank, they like to see a credit score at least in the 680 range, and they would prefer to see something in the 700s. The SBA, their threshold is 650-ish. So if you've got a credit score around 640 or 650, you may have success at the SBA. And there are other lenders. A lot of online lenders will accept a 600 credit score. There are some lenders that will accept a 550 credit score, but the lower your credit score, you should expect the terms to be shorter and the interest rate to be a little more expensive. So your credit scores factor in a lot of different ways. What's your business credit profile look like? It's just as important as your personal credit score, and they work together to enable you to access borrowed capital. Negative information that's going to impact your credit profile, like a bankruptcy, for example. If you have an unresolved bankruptcy that's less than 2 years old, the odds of getting any kind of business loan are very slim. So you want to be very aware that that's a question that you need to make sure you have answered and your ducks in a row. How long has my company been in business? If you are an idea stage startup, it is probably one of the most difficult places to be if you want to access borrowed capital. There are some options available to you, and I'll share those with you. But let me share this experience I had a few years ago. I had a business owner reach out to me, and he was starting a new business, and he had been to the local SBDC, and they had worked with him on a business plan, and he had his marketing plan and his business plan and everything all set to go. But he was an idea stage startup and didn't have any revenue. He didn't have any credit history for his business, and his personal credit profile was not very good. And he was frustrated that no one was going to lend him money. Well, without revenue and without a history, you're not going to get any money. And he was frustrated. He says, well, I can't execute my marketing plan. I can't execute my business plan. And I kind of encouraged him to step back and maybe bootstrap his startup a little bit. But he didn't want to do that. So I get the question all the time, what do I do? Because I don't have any business credit. I haven't been in business very long. Well, there are a number of things that you can do. The first thing that you can do is look at your suppliers. Many of them offer payment terms to good customers. And I recognize that 30 or 60-day credit terms aren't necessarily a small business loan, but it will help you build your credit profile, provided that supplier reports your good credit behavior to the appropriate business credit bureaus. I was speaking with an executive at Experian a few years ago, and he said that the healthy young businesses that build their credit profile the quickest all have one thing in common, and that is they work with their vendors to establish business credit. Crowdfunding is another good way to access capital if you're a brand new business and don't have the ability to borrow. And one of the things that I really like are business credit cards. You can often apply for and get a business credit card based on your personal credit profile alone. They're a little bit easier to get than a small business loan. It gives you access to borrowed credit. And if that credit card reports to the business credit bureaus and you practice, good credit practices, you'll be able to build your credit profile. So those three things are all options, but two of the strongest ways to build business credit if you don't have it are to look to your vendors and to look at business credit cards. How much revenue does your business make? Most of the times, small business lenders are looking at your annual revenue. That's the traditional metric that a bank or a credit union or the SBA is going to look at. One of the things that sets online lenders apart is that in addition to your annual revenue, they're looking at your monthly cash flow. They want to validate that you have the means to make periodic payments. And so they're going to look at how much money is flowing in and out of your business, as well as when does it flow in. If all of your revenue comes in at the end of the month, for example, or maybe at the end of the month and the middle of the month, lenders call that a lumpy cash flow. What they want to see is cash flowing into your business all throughout the month. And they want to make sure that you have adequate cash flow to service debt. And so a lot of lenders want you to link into your business checking account, which is a wonderful idea. It streamlines this process for you, and it gives the lender the ability to validate that the revenues and the cash flow in your bank account are adequate to make periodic payments. Also, just as an aside, you want to make sure that you have a business bank account. There are a lot of lenders that won't even talk to you if you don't have a business bank account. So even if you're a sole proprietor and you're working out of your home, you want to make sure you have a business bank account. Okay, let's go to question number 6. How quickly do I plan to pay it back? This is another question that I tie back to, what is your loan purpose? For example, um, if you're borrowing to buy quick turnaround inventory that you expect to be able to sell within the next 2 or 3 months, does it really make sense to borrow for the next 4 or 5 years? Probably not. If you're borrowing to build out an outdoor eating space in your restaurant, um, does it make sense to borrow for a little longer term? It could do. So what you're borrowing for really will impact the loan term. I look at it the same way I look at the difference between an auto loan and your mortgage. Most people I know would never buy a car with a 30-year mortgage. And why is that? It's just you'd be upside down in a matter of just a few years, and you would be making payments on a car that was not worth what you were making payments for, and you wouldn't be able to sell it and get out of the loan. So I look at short-term and medium-term and long-term loans um, as a way to match the type of financing that you're getting with the value of what you're purchasing. So if I was buying inventory that I was going to be able to turn around in 2 or 3 months, I would probably borrow for, 3 to 6 months or maybe a year, but certainly not longer than a year. So make sure that you match the correct term to your loan purpose. Something else you should know is that the shorter term loans will likely have a higher interest rate, but the total payout will be less because you're paying that off and your payment may be higher, but you will actually pay less overall than a longer term loan with a lower interest rate that's amortized over several years. So just make sure that when you're comparing loans and loan terms that you're making an apples to apples comparison, because there are times when a short-term loan, even if it has a higher interest rate, could be a much better opportunity for you. Okay, number 7, do I need collateral? This is a question that's answered by what type of loan are you getting and where are you going to go borrow? If you're going to borrow at a traditional lender like a bank, they are going to traditionally require some kind of asset as collateral. Usually it's real estate or equipment or something like that. The SBA is going to require that you collateralize as much of the loan as possible, but they don't always require you to fully collateralize. But you should expect at the SBA, a credit union, or a bank that you're going to need collateral. Many lenders outside of the traditional lenders will not require specific collateral, but they will make what's called a UCC filing. Basically, it's a lien on all of your business assets. And if you have more than one online loan, for example, if you have multiple UCC filings, it will make it difficult for you to get additional financing. You should also be aware, too, that there are a lot of lenders who watch for UCC filings, and you may get a phone call after you get one of these loans, and they might say, hey, I see you just got a loan from so-and-so. Could you use another $5,000? Well, knowing how I feel about borrowing exactly what you need and no more, that's one reason not to go that route. And the other, this is called stacking. And another reason not to do that is because they're underwriting your loan based upon the previous lender's underwriting. And so that lender that's in first position is in jeopardy if you default, because they don't know anything about this second loan. And so UCC filings are just a way to, it's not really collateral in the traditional sense, but it is collateral. If you are borrowing with equipment financing, the equipment you're purchasing is considered collateral. So you don't have to worry about additional collateral. And that applies whether you're buying a big dump truck or computer equipment for your office. What is the impact of a personal guarantee? And are you going to have a personal guarantee? For most small business owners, whether they go into the bank, the SBA, an online lender, or any other kind of financing, the lender is going to likely want a personal guarantee. And basically, what that means is that if you default on the loan, there is the possibility that they would come after your personal assets. Um, However, the stronger the qualifications of your business as far as time in business, your track record, your credit profile and all those kinds of things, the less likely that's going to happen. But for most small business owners, a personal guarantee is likely going to be required. What industry are you in? Industry makes a big, huge difference. If you go online and look at a lender's website, they will always have some kind of restricted industries page where you can dive in and find out if there are industries that they will not lend to, because some industries are more risky than others, and are some lenders choose not to loan to, say, a bar or a cannabis dispensary, or businesses like that, as well as those with SIC codes that are considered to be a little bit more risky. This is one reason why you want to make sure that you're able to review your business credit profile, because it's not uncommon for the wrong code to be assigned to your business, putting you in a more risky category. So you want to make sure that your business credit report is accurate. And fortunately for you, all of these credit bureaus are very motivated to make sure that the credit profiles that they have on you are accurate. So there are mechanisms in place for you to correct inaccuracies. One way to check this out to get started is NAV offers a free account. You can dive in and view your personal credit scores and your business credit profile for free. So if you go to nav.com, you can sign up there. The next and the last question you need to ask is, am I ready to apply? You want to make sure that you qualify for the lender that you're going to. If you have a credit profile of 600, it probably would be a waste of time to go into the bank. You want to make sure that whatever their qualifications are to apply, that you meet those and that you match those, and NAV can help you with that. However, years ago, I was speaking with a borrower in Arizona. She had been around for a while, a couple of years. She had a good credit profile, and she went into the bank, and it was the bank that was considered to be the small business lender in her area. And she filled out the application. It was like a 40-page application. She was pretty frustrated. She called several times to her loan officer to get help to fill it out, and then she submitted her application. Several weeks went by, and she called back, and he didn't know why he wouldn't tell her why she didn't qualify, or it was taking so long. And after another week, she called, and he said, "Well, you don't have 2 years of business tax returns completed." She only had one. Well, that was a requirement that they knew up front, but for whatever reason they missed it, and so she wasted 3 weeks trying to trying to get through the application process when she knew she didn't she didn't qualify before she even submitted the application. She went online, was able to get improved that day, and was able to get the money that she needed in another day or two because she did qualify with one of these other lenders. So, do you qualify? Um, be prepared. Do you have all the information that you're going to need to apply ahead of time? You know, we know that they're going to want to know your credit profile. You need to know what your profile is before you go in there. You know they're going to want to know what your revenues are. They're going to want to validate those revenues. So your P&Ls, your bank account information and all of that stuff, you're going to want to be prepared with that. And if they want to access your account, I recommend that you allow that. And then if you're a young business, be prepared to take small steps. These things don't always happen overnight, but if you take small steps and work towards the ultimate goal, you'll eventually be able to access the capital that you need. One of the reasons why I really like paying attention to your credit profile and looking at this information on a regular basis is because we tend to positively impact the things that we pay the most attention to. And this is one of those things. If you're looking at your business credit profile and your personal credit score every month, you're going to take those actions to improve it and to make it better and to improve that metric. And so I recommend that. So how do you get started getting a small business loan? Review your business financing profile with a free NAV account. It costs you nothing. You can go there and see what your business credit profile looks like. You'll also be able to go there and see what options you currently have available. NAV will help match you based upon your profile with financing that you are more likely to qualify for. Understand the qualifications that you need and where do you need to improve. This is not a one and done sort of thing. You can improve over time, and you should take those actions. I also recommend if you're a new small business owner, get a business credit card and establish a business banking account and start building your business credit profile. And then again, one last time, if you go to NAV, you can watch your matches improve as your business grows. I hope this information was valuable to you. And it looks like we have a few minutes left. I don't see any questions, but are there any questions? I'd be happy to answer questions for you. If not, thanks again. I appreciate you being here. I hope this information was valuable, and good luck.